So, you're curious about day trading, right? But maybe you feel like it's this super complicated, overwhelming world. Well, you're in the right place. Today, we're going to cut through all that noise. We're going to lay out a simple, clear roadmap to get you started on the right foot. Let's just dive right in. So, let's start with the big one, right? Is day trading just glorified high speed gambling? I mean, it's a huge misconception. You see those charts flying around, and it's easy to think it's all just luck. But here's the thing, successful day trading, it's not about guessing. It's about process, it's about psychology, and honestly, it's about a specific kind of math that's probably going to surprise you. And we're going to break that all down. All right, here's the game plan for today. First, we'll cover what day trading even is. Then, we'll get into the psychology of winning. This part's huge. After that, your toolkit, how to actually find a strategy. And finally, how to go from just practicing to hopefully making a profit. Let's get to it. Okay, first things first. What are we really talking about when we say day trading? Before we even touch on strategies or tools, we got to understand the absolute core idea. Like, why do these markets move at all? When you really boil it down, a price chart is just a picture of human emotion, right? It's just buyers versus sellers. If there are more people wanting to buy than sell, guess what? The price goes up. If there are more sellers flooding the market, the price goes down. It's this constant tug of war that creates what we call volatility. And it's right there in those little daily price swings that a day trader looks for their chance. And this is where we need to draw a really clear line between investing and day trading. Think of an investor as the tortoise in the race. They're in it for the long haul, months, years, hoping for maybe a 10, 20% return. A day trader? We're the hare. We're zooming way in, focusing on all the tiny little price wiggles that happen in just one day. We're trying to grab a profit from that short-term action that long-term investors just, well, they don't even see it. All right, now we're getting to what is, and I'm not kidding, probably the most important part of this whole thing. Seriously. All the fancy charts and software in the world mean nothing if you don't get this next part right. This is the mental game, and it will absolutely make or break you as a trader. This right here, this is the biggest mental hurdle you have to clear. Think about it. Since we were kids, we're taught losing is bad. Being wrong means you failed. In trading, you have to completely flip that idea on its head. A small, controlled loss isn't a failure at all. It's just the cost of doing business. It's the price of admission to give yourself a chance at a really big win. So, how do you actually do that? How do you control those losses? Well, pro traders use a simple concept called R. R just stands for your unit of risk. It works like this. Before you even think about entering a trade, you decide the maximum amount of money you're willing to lose. Let's just say it's $100. That $100 is now 1R. And from now on, the entire game is making sure your wins are multiples of that 1R. Let's make this real. Look at this example of 10 trades. Imagine you take seven losses in a row. Ouch! Each one costs you exactly your 1R. Man, that would feel pretty discouraging, right? But then, look what happens. You get 3 wins. One pays you back 5.2 times your risk, the next one 2.5 times, and the third over 3 times your risk. You do the math, and boom. Those 3 wins don't just cover your 7 losses. They leave you with a nice profit. And here's what that looks like visually. Just look at this. You lost 70% of the time. Let that sink in. In almost any other job or field on the planet, a 70% failure rate gets you fired. But in trading, with the right risk management, this can actually be a very profitable system. And let's put a dollar amount on it. If your 1R, your risk, was $100 per trade, you'd be up $380 after those 10 trades. And this, right here, is the aha moment for so many traders. It's the proof that you can be wrong a lot and still make money. The only thing that matters is that your wins are bigger than your losses. That's it. Okay, so we've got the mindset down, which is the hardest part. Now let's talk about the practical stuff, the tools you'll actually need to get going. And honestly, there are only 3 things you absolutely have to have. Yeah, think of it like a simple workflow. Number 1, you need charting software. Something like TradingView is super popular. This is basically your command center, where you do all your analysis. Number 2, you need a trading platform. This is where you actually, push the buttons to buy and sell. And number 3, and listen, this one is not optional. You need a trading journal. This is how you prove to yourself with cold, hard data that what you're doing actually works. But you know what? Of all these tools, the most critical one isn't even the charts or the platform. It's a system for calculating your position size. It could be a spreadsheet, whatever. This is the thing that connects your psychology to your actions. It's what makes sure that on every single trade, you are only risking that predefined 1R that you decided on. No more, no less. Okay, so you've got the mindset, you've got the tools. Now for the big question, how do you find a strategy that works? Well, here's a little secret. You don't really find a strategy, you build one. And you do it through a clear, simple process. It all starts with just a concept, an observation. You're just looking at the charts and you notice something that seems to happen over and over. Then you take that observation and you forge it into a hard and fast set of rules. No gray area. If this happens, I do this. Finally, you evaluate it. You go back and test your rules on tons of past data to get the numbers. What's my win rate? What's my average win? What's my average loss? So, where do you even get these ideas? A lot of times they come from simple visual tools. Maybe you're identifying a clear trend, up or down, or you could use something like Fibonacci levels to find potential bounce points. Some traders look for what they call fair value gaps, these areas where price moved really fast. The specific tool doesn't matter as much as the process. They're just ways to help you form a hypothesis that you can then go and test with rules.
And this chart right here is the goal of all that testing. You need to prove, with data, that your strategy spits out a result that looks like this. See how the average loss is kept tiny and controlled, like $100, but the average win is way, way bigger? This imbalance, this asymmetry, is the mathematical engine that drives a profitable trading strategy.
All right, let's pull this all together. You've done the work, you've built a strategy, you've tested it, and the data says it has an edge. So, what are the final, super important steps before you risk a single real dollar? You have to walk before you can run. You start with what's called backtesting, testing your rules on old historical data. Once it passes that test, you move to simulated trading or paper trading. You're in the live market, but you're using fake money. And only, and I mean only, after you've proven your strategy works in both of those stages, should you even think about trading with a small live account. And just a quick, important word on leverage. Leverage basically lets you control a much bigger position than the money you have in your account. It can be a fantastic tool for growing a small account, but it is a double-edged sword. It's incredibly dangerous if you don't know what you're doing. It should only ever be used after you have a proven, tested strategy and your risk management is basically second nature. Think of it as an amplifier. It'll amplify your wins, but it'll also amplify your losses. So let's just wrap it all up with this one final thought. Here's the truth. Nobody knows what the market is going to do next. It's fundamentally uncertain, it's chaotic. But that doesn't actually matter. Your job as a trader isn't to be a fortune teller. Your job is to build a process, a disciplined, repeatable process that you follow no matter what. Because while the market will always be uncertain, your process can be rock solid.